Hello everyone and a very warm welcome to today's major markets update for Wednesday, March the 5th, 2025. Is a bottom in place? But before we go there, I want to say that on the one hand, we must always consider charts to have autonomy, a separation and logic on their own that is bracketed from news that is all too often just a distraction. That's why we use the Elliott Wave, as it purely tracks price. On the other hand, we do have larger macroeconomic pictures and influences, and given of course the uncertainty principle, all these technicals that we analyze are hedged against that, because anything can happen. Maybe Zelensky tomorrow will push the all-out war button. We don't know. Most likely not, but you know, and you get the idea of what we mean. So we assess the charts one by one, each on their own merit, knowing that all this news is noise and that they are moving on a logic by themselves. And that logic is, of course, in this case, the Elliott Wave, as it is the one and only way to qualify and quantify where things are most likely going to head next. We believe the stock market is currently and most likely has now bottomed for this smaller fourth wave, is on its way for a smaller fifth wave, a large fourth wave, again akin to 2022, and then a final fifth wave to wrap up this entire bull market that started in the 1930s. Let's go straight to the charts. We're going to start off here with the regular NASDAQ, which has certainly declined a lot further than we originally anticipated. Originally, we were looking here for this wave 4. Now remember, way back, we were thinking this could be an A, a B, and a C. We get a pullback, we get another rally. Okay? Why? Because in ending diagonals, as I've shared, all these rallies are all three waves. Okay? However, using the Elliott Wave, we knew that we had certain price levels below which this advance to the ideal upside target would become in jeopardy, and the ultimate line in the sand was here at around 19,000. We could not go below 19,000 because then this could not be an ABC for an A, then an ABC for a B, and an ABC for a C. Okay, so once we broke below 19,000, we knew we had to look lower, and we had 18,811. Below that, we had 18,400, and we had even as low as 18,000. Now you can see price is still within a long-term uptrend. Sorry, my hand is not as stable. And that is really good. We're holding above the 200-day simple moving average. What I like here is, although it's of course a condition, not a trigger, we have positive divergence on the RSI 5. Money flow is still positive, and we're holding the 200-day moving average. We've moved back inside the Bollinger Band. We've done 5 waves lower, as you can see, so this wave 4 can be considered complete. It's definitely deeper than originally anticipated, but it is what it is. Now again, we thought this was a larger A wave of this fifth wave because the S&P 500 and NASDAQ 100 and almost the Dow Jones made a new all-time high. Turned out to be a irregular B wave, akin to what we saw just before the COVID crash. And I think I can point it out in a later slide from the monthly chart for the S&P 500. Irregular B waves can happen, and then we have a irregular expanded flat fourth wave for the S&P 500. And irregular B waves actually mean the market is quite bullish over the intermediate to long term, because the correction of the correction, which is the B wave, moves in the direction of the long-term bull. Overall, still in a long-term uptrend. So this could have bottomed today. Moving on to the NASDAQ 100. Here we can see that the NASDAQ 100 didn't really reach its ideal upside target. It's even more pronounced for the S&P 500, but we go over that one in a moment. Normally, the third wave targets 138.2 to 123.6. Okay, we just went slightly above it for 2 days. Then the fourth wave tends to go to the 61.8 to 76.4%. And then the fifth wave on a 5S1 goes to 161.8 to 176.4. That is the ideal Fibonacci-based impulse pattern for, in this case, a diagonal. We're holding the 200-day moving average. We held it yesterday, we held it today, and now we need to, of course, to break above yesterday's high, 20,695, to get us the first higher high and as well a higher low setup. Then today's low was higher than that of yesterday, and then of course we also will get a higher high. Also here, a lot of positive divergence on the RSI 5, but again, that is a condition and not a trigger. But again, we bottomed exactly where we had to, okay, for this wave 4. That's really nice. The alternative is that we have bottomed indeed for this wave 5 already, but I'm not going to show the alternative. You know that one. I'm just going to show our preferred wave counts, and this seems to be a nice, irregular, expanded, flat fourth wave. Quite common for a fourth wave, very difficult to track. Again, also here, we could have then bottomed already for this wave 4 in January, right there. And then this is then ABC for wave 5. Again, we failed a bit reaching the ideal upside targets, but in a ending diagonal, we have ABC for 1, ABC for 2, ABC for 3, ABC for 4, and ABC for 5. Okay, so we got ABC for 1, ABC for 2, ABC for 3, ABC for 4, ABC for 5. So technically we could have topped, okay? The bulls are not out of trouble just yet. Ultimately, we need to break above 22,100 to negate any bearish setup. Okay, but this again looks as good as we get, so we're going to look higher, and we also want to break above Monday's high at 21,075 to further signify that a good low is in place. However, if we have topped for a larger fifth wave, then this is probably wave 1/A, and then we're going to do 3 waves higher, an A, a B, and a C for wave 2B, and then we're going to go lower. However, as I'm going to share with you, and although it is just an average, seasonality and of course extreme bearish sentiment do not agree with that wave count. This is the S&P 500, came within 4 or 5 points of the ideal target zone. We already got there in January, okay? So again, as I pointed out for the NASDAQ 100, we could have just completed wave 4 right there, and that is wave 5 because we did an ABC lower and an ABC higher, but we miserably failed reaching the ideal target zone. We target zone for wave 3, we reached the ideal target zone for wave 4, but miserably failed for this wave count to reach the ideal wave 5 target zone. Now, the market doesn't owe us anything. It doesn't have to follow Fibonacci, but it's a little bit odd, right? You can see how accurate the market can be if it wants to for a Fibonacci perspective. So we've broken below this first, the second, but not the third and the fourth warning level for the bulls just yet. And actually, we're back above the first warning level that was set last Friday. That was, of course, last Friday's low. And yes, last Friday, we failed miserably in forecasting the current decline. But you can see we're starting to make now an initial and first higher low. That's good. So as long as yesterday's low holds, especially 57.28, we can move higher. And I really don't want to see it go below 56.50. Yes, we can still go one more step lower. Okay, but I do not want to see it go below 56.50. Also here, we have positive divergence on the RSI 5 on the daily time frame, which technically tends to be enough to kickstart a new rally. But again, we definitely need to break above Monday's high to start to suggest the downtrend is over. Okay, so the warning levels for the bears, the first one here is 58.38. We cleared that one. We closed at 58.45. The second warning level for the bears is now at about the 50-day moving average at about 59.88. And I would say the third warning level for the bears is at about 60.60. And then the final one is, of course, 61.50. Okay, that's the final one. And you can see there's not much wiggle room left here. We can extend, but the 5-1 relationship targets 62.60. This is the bigger picture Elliott wave count all the way back to 2015, I believe it is. So here you can see a massive, large, irregular B wave. ABC lower, ABC higher, 5 waves lower. Okay, so this is a irregular expanded flat. So this is wave A. A wave A by itself was a flat, wave B, and then 5 waves lower. And that kind of looks similar to what we saw here, right? So here we have 3 waves lower, 3 waves up, 5 waves lower. Now we can still tag on one smaller wave, but it starts to look like it has completed. But just to show you that on bigger time frames, we can see similar patterns. Then the 2021 high was wave 1, wave 2. And here, I don't think we've topped just yet. Why? Because we've just reached 100% extension, which is more likely that of a third wave. They tend to reach the 100% extension. You can go on my website, look it up. Avi Gilbert on elliottwavetrader.net has it as well. That's more classic for a third wave. Even in a ending diagonal, that is quite uncommon for all of a wave 3, which tends to target, as we just saw on the daily chart, anywhere between 123.6 and 138.2, even in a diagonal. So this could be a diagonal within a larger diagonal. And ultimately, this targets about 7,700. Okay, so this is the larger decline we just talked about. If we're going to see this rally, okay, if we're going to see this, then it should go potentially as high as 67.49. Now, 67.49 is a little bit above, of course, 62.61, but we'll take it day by day and week by week. And of course, we can just top out at about 114% extension. I don't have it here, but I'll add it for extra granularity. And then we should see a larger 4th wave pullback and then a larger 5th wave. That's the ideal preferred Elliott wave count. Now, I do have some problems with all this mess that's here, but it is what it is. This looks like a 1, 2, 1, 2, 3, 4, 1, 2, 3, 4. Okay, so far so good. I do want to point out it's very hard for the markets to top out considerably after being quite overbought. This is the Dow Jones, and the Dow Jones is just holding on by a thread, and that is that we could have bottomed for this wave 2/B. If we break back above Monday's high, this wave 3/C is confirmed for the final wave 5 of a larger third wave, which will match with that of the Dow Jones. I'll show you of the S&P 500. I'll show you that in a minute. So this was then a very deep retrace, and yesterday I gave a warning that we did break below the third warning level for the bulls, starting to suggest this might morph into something else. How would that then be something else? Then the wave 4 is still ongoing, and then what we got here was wave A of 4. Okay, this is then wave there, this is then wave B of 4, and this is wave C. So we did get a 5-wave advance, and C waves are often 5 waves. So then we have A, B, C. Okay, so this is A, and this is a smaller B, larger C. So this is then a bigger B wave, and this is then going to be a 5-wave decline for C. And then we move this whole 4th wave that way. Okay, so then we have, in this case, a irregular, very expanded flat B wave. Let me rephrase that one more time. So then this is wave A of B. This is wave B. Technically, it's a different color. This is then wave A. This is also wave B, and this is wave C. C waves are 5 waves, 1, 2, 3, 4, 5. And then we get a 5-wave decline for the C wave. Okay, and then we'll retarget 42,000, somewhere around there. Not 41,000 all the way, but more closer to 42,000. And this would then be a regular flat wave 4, with the B wave, if that's the case, being a irregular expanded flat. Very tricky, but it's possible. For now, also here, we have lots of positive divergence going on. It's a condition, it's not a trade trigger, and we need to hold yesterday's low to allow for this potential 2/B wave to complete. Okay, meaning we need to now see higher highs, break above about 43,800, I believe it is, somewhere around there, this wave 4, and then for wave 3C. Now, this is the bigger picture chart. Again, you can see all the way back to 2009, 1, 2, 1, 2, 3, 4, 3, 4, massive, large, irregular, expanded flat wave 4. as you can see. And then the 2021 high was wave 1, a wave 2, 1, 2. This was a irregular running flat to wave 2 and a wave 3. And we should have bottomed for this wave 4. If not, so akin to here, you get this here. If not, then of course we move the wave 4 forward in time, and we still need a wave 5. Why? Because we haven't reached even the regular third wave extension for a ending diagonal at a minimum of the 100%, ideally the 123.6. Now, if we zoom in, I do want to point out the 161.8% extension targets exactly almost the 100% extension of the wave 1 measured from the wave 2 in black. So you can see how green overlaps with black. Black should ideally be at about 47,465, and this would target 47,524. Okay, again 47,500. So this could be very possible for a ABC for wave 5 or 3. Then we get the pullback for wave 4 all the way back to 40,000, and then a 5 is 1. Okay, that would be ideal. So if we can hold yesterday's high, we can now go for the wave 3. And then we should see a big pullback for wave 4, and then the final wave 5 for this massive large ending diagonal. I do want to point out there is no negative divergence on the monthly MACD. We made a new high. Often that means we will see a new high in price as well. Normally what you want to see here is negative divergence, just as we saw here from 2017 going into 2020. This is negative divergence while price went higher. The same here in 2014-15. Negative divergence also on the RSI 5. We don't have that right now. Okay, money flow is still positive, which is great, but the MACD tells us we should see a higher price and potentially then with a lower high. Okay, that's the idea, and then we'll get, of course, that negative divergence. That's what we're going to look for. So the MACD should make a lower high, and of course price should make a higher high, and then we go like that. Okay, and that of course will continue, and the worse it gets, the better it is to tell us that the blue wave 5 has then will then finalize the blue wave 5. Okay, that's how we view the market for now. What a disastrous mess. Just look at this price action since August last year. This is more than half a year of disaster, and we could have completed wave C3 of this potential WXY of a very complicated ABC pattern, and now on our way to that very pesky gap fill at 5,700. I still would like to see it. It's not necessary, but we did fill the gap here from the DeepSeek debacle. ABC higher, and we need to break above 47.73 to suggest there will be no 4-5 setup. Okay, because we can still have a 4-5 setup. Okay, it's still possible, and then even that one can still move there, but boy, that's 5 waves lower from this one. That would not be good. Then this is 1, 2, and then 3, 4, 5. Then I'm going to look for just a counter trend rally for a wave 2, and then we're going to see a massive decline, which would still match very well with the overall Dow Jones wave count. Okay, so the 4 in the Dow Jones would then probably be a larger third wave down for the semiconductors. So the final push for the Dow Jones would then be a B wave. Okay, and then the C wave will be akin to that for the 4th wave in the Dow Jones. Last but not least, IWM appears to be expanding ending diagonal. We've reached the downside targets. Nice reversal back within the uptrend. We're of course well below all the moving averages, so this is still a 100% bearish chart. Nothing bullish about this. At a minimum, we need to break above Monday's high to start to suggest that the low is in place. Yes, we have positive divergence, but that's pretty much all there is to it. Yes, we're extremely oversold, etc., etc. There are still above the warning levels that are really of significance. This third one at 202 and the final one here at 195 to consider this 4th wave still as a potential. We did reach the CSA target zone, so yes, we can still go to 253. Again, normally in a ending diagonal, wave 3 goes to the 123.6 to 138.2, and that's exactly what we did here all the way back in November. Definitely saw a much deeper drop for the wave 4. It is possible, and now the wave 5 can still target the 161.8. Okay, That's kind of what we're looking for. Oh boy, it dragged along that one. All in all, this still looks like a diagonal. Once again, you have all ABC pattern. ABC for 1, ABC for 2, ABC for 3, ABC for 4, and an ABC for 5. That is the preferred path going forward. And no, we don't have to go all the way up to that trend line. Trend lines are not as important. They are important, but not as important. Wave count matters first. All right, a few words about seasonality. And this is the seasonality chart I shared with you on Friday, showing that we should have expected a bottom in late February. We did bottom, of course, on February 28th, and then we should have rallied. However, of course, we dropped yesterday and Monday, and that we did not capture with this granularity on the post-election chart. So what's going on? Well, first and foremost, we might have to move this seasonality a little bit forward. Okay, it's kind of like always plus or minus, I would say, 3 days. Okay, it doesn't have to be exactly a dot, but it would be great. So if we move this forward for the S&P 500, we're going to go back to the S&P 500 and check where we topped. As you can see here, we topped here better in mid-February than in early February, because seasonality has a top here in early February. So move it forward a week, and then of course the low is also going to be moved forward a week. So far so good. Now there is actually a even granular chart where this is from Jeffrey A. Hirsch at Almanac Trader. This is from stocktradersalmanac.com. It's posted on X, and I give credit to him for posting this, where they teased out not only the post-election years, which are in black, which is of course exactly similar to what I just shared with you, but they also looked at who was the winning party. Was it the incumbent or was it the opposition? In this case, the opposition. And in that case, we should see a final low early March. Okay? So if you only look at post-election years, you would see a low late February. Tease it out for who actually won the election. It's going to be early March, the first week of March. And from there on, the pattern is pretty much the same. Rally into May, down into July, rally into August, down heavily. So this would fit with what we're seeing right now as well for the indexes. If I move back a little bit here, let's go to the IWM. So we should possibly rally now into March, decline, okay, rally into May, decline bigger, and then rally. Okay, that's kind of the idea we're going to look for. Seasonality is not the most reliable, but it's been tracking reasonably well. Also here you can see that the top here was of course off with a little bit of that top, but the overall pattern is the same. So once again, it really looks like we're going to shift towards a bullish phase and not a bearish phase. This is the NYSE AD line, and I wanted to share you all those moments when it broke above downtrend lines and what happened to price. As you can see, this was always really good for price. And we're currently tracking the decline that started in February and what happens when we break above it. Most likely good times ahead. So watch this one carefully, and we'll share it once we see a breakout. How we're doing on the PMO buy-sell indicator, it's of course extremely sold out. So to say, it's at 0. And once again, all those occasions where it was at 0 and then we got a buy signal were very good signals. No guarantees. It's not always great. 60% of the time it works every time. But also this one suggests, well, we're much closer to a bottom than we are to a top. That's really the bottom line here. Intermediate term, yes, this indicator is still on a sell. It went into a sell mode a little bit earlier this month, as you can see. So this one is still, of course, bearish. But it's a slow moving indicator, so it will take a little bit before it turns bullish. And that, for example, you can see here, it turned, let's see here, bearish right there, and then eventually bullish there. Okay, so it takes a little while for it to catch on. I also wanted to share the NEMO VIX SPX buy signals. Okay, this chart unfortunately doesn't have the NEMO data and YSE Cleland oscillator for today just yet, but I wanted to point out several key things. First of all, negative divergence in the NIMO, I guess, versus the S&P 500 is rarely a top. Okay, you can see here that we have had lots of negative divergence and the index just continued to creep higher. Positive divergence at the bottom, however, is much better. Second, if we see price move below -40 and then outside the Bollinger Band closes back inside the Bollinger Band, that's a good buy signal. Same for the VIX and the S&P itself. If the VIX closes above the Bollinger Band, then closes below the Bollinger Band, which it did today. Yesterday it closed above it, today it closed below it, and then we'll see tomorrow a lower close. That's a good signal. Okay, 60% of the time, it works every time. Same here for the S&P 500. If it closes below the Bollinger Band and then closes inside the Bollinger Band, it's a good signal. However, we've had that here before. This was on Friday. Okay, and then of course you got Monday, Tuesday. So it doesn't work all the time, but most of the time. If you look here, for example, in December, this is what we got. A close below it, a close inside of it. Okay, so that's pretty decent reaction. And then of course we got our rally. It doesn't mean we're going to instantly move there, but we got our rally. Okay, and then of course the decline happened. So just want to show you the term of SPX buy triggers and SPX sell triggers. And that's all we have for today. Remember, we cannot reliably forecast everything up to 100% degree. But as you saw yesterday when we forecasted on Monday that we see 58.28 for the S&P 500, we got 58.32, I believe it was, or maybe 57, whatever the number is. I don't know all by heart, but we got 57. So we forecasted around 57.28. I think we got 57.34, and that brought us back to the accuracy that you are used to and that you can demand from us, so to say. You might need to narrow it down to plus or minus 0.5% accuracy, or maybe 2.5%. That remains to be determined, but so far so good. Again, showed you Friday we were wrong because we got Monday, Tuesday. Today we were right. However, the day before Friday we were once again correct. So can't always forecast it entirely correct, but this looks as good as it gets for a low of this wave 4 being in place. If we go below 57.50 for the S&P 500, we have to consider a much more serious correction than this larger wave 4. We'll probably go to about 5,500 before we see the wave 5. Otherwise, our preferred wave count is that we still see higher prices for a larger fifth wave to that 62.60 level for the S&P 500. Things are aligning well. Seasonality looks good too. Wish on Friday we had, of course, the Traders Almanac granularity of incumbent party loses, but this also looks really good for a low being reached soon has already been put in place. It doesn't really get any closer than we got, and we should now start to move into a bullish phase, which should last into mid-May, with of course usual pullbacks and of course some weak periods like late March, late April, and then after May we might get the sell in May and go away to July and then a final rally. So once again, so this could then be wave A of 5, this could be wave B of 5, and this could be wave C of 5. That completes then our larger third wave. Then we get our larger fourth wave and then our final fifth wave to complete the bull run. That's all I have for today. Take care, trade safe, and have a great rest.